You can draw the most beautiful map in the world. But if you're reading it upside down, you're still going to end up lost. Financial plans work the same way. People spend hours building budgets, calculating retirement numbers, and setting savings goals that look absolutely flawless on spreadsheets. Then, 3 months later, everything falls apart, and they can't figure out what went wrong. The truth is that most financial plans don't fail because the math is bad. They fail because they rebuilt on assumptions that have nothing to do with how human beings actually live. Today we're going to talk about the invisible cracks that destroy even the most carefully designed financial strategies. And more importantly, how to spot them before they cost you years of progress. Let's start with the most common illusion that derails financial planning. People assume their future behavior will be radically different from their current behavior, with zero plan for how that transformation will actually happen. Someone who has never consistently saved money will create a budget that requires them to suddenly save 30% of their income every single month. Someone who impulse buys constantly will plan to stop cold turkey starting next Monday. The plan looks perfect on paper because it's based on an imaginary version of themselves, not the actual person sitting in the chair right now. This isn't about willpower or discipline. It's about the fundamental mistake of treating behavior change like flipping a light switch when it actually works like growing a plant. You don't go from zero savings habits to aggressive investor overnight just because you wrote some numbers in a spreadsheet. Real change requires scaffolding, intermediate steps, and systems that work with your current patterns instead of demanding you become a different person. The second place where plans quietly collapse is in how they handle time. Most financial strategies treat time as a smooth, predictable resource that flows at a constant rate. They'll project 10 years into the future and assume each year will be roughly equivalent. But real life doesn't work in averages. It works in clusters and droughts. You might have 3 years where everything goes smoothly, then 1 year where your car dies, your roof leaks, and your company restructures all within 6 months. Traditional financial planning tries to smooth out these peaks and valleys by telling you to build an emergency fund, which is good advice, but it doesn't address the deeper problem. The deeper problem is that plans are static, but circumstances are dynamic. A budget that worked perfectly when you were 25 and single becomes completely inadequate when you reach 32 with 2 kids and aging parents who need help. The plan didn't fail because you did something wrong. It failed because it wasn't designed to evolve. Here's where things get really interesting. Financial plans almost always overestimate income stability and underestimate expense volatility. They'll take your current salary, maybe add a modest raise each year, and project that forward. Meanwhile, expenses are listed as fixed monthly amounts: rent, groceries, utilities, insurance. But income's actually far more fragile than people realize, especially in modern economies. Industries shift, companies downsize, skills become obsolete, health issues arise. At the same time, expenses have this sneaky way of expanding beyond what you originally budgeted. It's not because people are careless. It's because life presents you with situations where the technically optional expense feels practically mandatory. Your kid needs tutoring because they're falling behind in school. Your teeth need dental work that insurance won't cover. Your industry requires a certification that costs $2,000. None of these were in the original plan, but they're not exactly luxuries either. The plan breaks because it was built for a version of reality that's cleaner and more predictable than the one you actually live in. Another critical failure point is how financial plans handle relationships and shared decision-making. A huge percentage of people create financial plans as individuals, but then they live their financial lives as part of a household or partnership. Your plan says to save $500 this month. Your partner thinks you should spend that money on a weekend trip because you both need a break. Your plan says to pay off debt aggressively. Your parent calls asking for help with their medical bills. Your plan says to invest for retirement. Your friend invites you to be part of a business opportunity that requires upfront capital. Every single one of these scenarios involves other people whose priorities, emotions, and needs don't show up anywhere in your spreadsheet. Financial planning that ignores the social and emotional context of money is like trying to play chess while pretending the other player does exist. You can't make good moves if you're only thinking about your own pieces. Let's talk about the role of identity in financial failure. People don't just want to be financially stable. They want to feel like certain kinds of people. They want to be seen as generous, successful, responsible, fun, sophisticated, or caring. These identity needs are incredibly powerful, and they don't shut off just because you made a budget. Someone who sees themselves as a generous person will struggle with any financial plan that requires them to say no when friends need help. Someone who ties their self-worth to career success will have trouble sticking to a plan that involves taking a lower-paying but less stressful job. Someone who values experiences will feel suffocated by a plan that's purely focused on delayed gratification. The plan isn't failing because it's mathematically wrong. It's failing because it's asking you to betray a core part of how you see yourself. And most people will abandon the plan before they abandon their identity. Effective financial strategies have to work with your identity, not against it. That might mean building in a category for generosity, or finding ways to feel successful that don't require spending money, or structuring your savings so they enable experiences rather than just accumulate in an account you never touch. One of the most overlooked reasons financial plans fall apart is mental accounting. This is the way people psychologically separate money into different buckets, even though it's all technically the same resource. You might be incredibly disciplined about your grocery budget, but totally careless with money you think of as bonus or unexpected income. You might refuse to touch your retirement savings even in an emergency, but have no problem carrying credit card debt at 18% interest. You might obsessively track every dollar of your paycheck but forget to account for annual expenses that hit once a year. These mental categories feel natural and helpful, but they create blind spots. The plan says you're saving 10% of your income, but it doesn't account for the fact that you spent your entire tax refund on things you wouldn't have bought otherwise. The plan says you're debt-free except for your mortgage, but it doesn't include the $4,000 you owe your parents that you do and think of as real debt. Financial plans need to account for how you actually think about money, not just how money objectively exists. There's also the issue of optimization versus resilience. Most financial plans are built to optimize for a specific outcome. Maximum retirement savings, fastest debt payoff, highest investment returns. Optimization is appealing because it feels efficient and smart. But optimization creates fragility. A system that's perfectly optimized for one set of conditions breaks immediately when conditions change. Think about a budget that has zero slack in it. Every dollar is assigned a job and there's no wiggle room anywhere. That budget might be theoretically optimal, but it can't absorb any surprises. One unexpected expense, and the whole thing collapses. A more resilient approach would deliberately include buffer room, even though that's technically less efficient. It would prioritize flexibility over perfection. It would accept slightly lower returns in exchange for much lower stress and much higher probability of actually sticking with the plan long term. The irony is that the less optimal plan often produces better real-world results because it's built to survive. It's contact with reality. Another common failure point is mistaking activity for progress. Financial plans give people tasks to do. Track your spending, review your budget, rebalance your portfolio, compare insurance rates. These tasks create a feeling of productivity and control. But activity doesn't automatically equal progress. You can spend hours tweaking your budget categories without actually spending less money. You can obsessively check your investment accounts without improving your returns. You can read a dozen personal finance books without changing a single behavior. The plan becomes a form of productive procrastination. To feel like you're rehandling your finances without actually making the difficult decisions or comfortable changes that would create real results. This is especially common with people who are naturally analytical or like to research. They can spend months in the planning phase, perfecting their strategy, waiting for the perfect moment to start, when the real issue is that they're avoiding the emotional discomfort of actually implementing anything. Plans also fail because they don't account for success. That sounds backwards, but think about what happens when things actually go well. You get a promotion and a significant raise. Your plan says to save the extra income or pay down debt. But your lifestyle immediately expands to match the new income level. You move to a nicer apartment, you start eating out more, you upgrade your car, you take bigger vacations. None of these decisions feel extravagant in the moment. They feel like natural adjustments to your new income level. Before you know it, you're remaking 40% more than you were 2 years ago, but somehow still living paycheck to paycheck. The plan didn't account for lifestyle inflation, because it assumed you'd have the discipline to resist it. But lifestyle inflation isn't really about discipline. It's about adaptation. Humans adapt to their circumstances. What felt like a luxury last year feels normal this year and feels essential next year, without explicit systems to prevent it. Your spending will always rise to meet and slightly exceed your income, no matter how much you make. The final major failure point is emotional sustainability. Financial plans are often built like diets. They require constant restriction, constant vigilance, constant saying no to things you want. And just like diets, they fail because people can only maintain that level of restriction for so long before they burn out. You can white-knuckle your way through 3 months of aggressive saving. But eventually, you hit a breaking point and spend everything you saved in one weekend. The plan didn't fail because you're weak or undisciplined. It failed because it demanded a level of ongoing sacrifice that no normal human can maintain indefinitely. Better financial strategies build in release valves. They include money that can be spent guilt-free on things that make life enjoyable right now, not 30 years from now. They focus on automating good decisions, so you don't have to rely on willpower. They create wins and milestones along the way, so you feel progress instead of just deprivation. The best financial plan isn't the one that maximizes every dollar. It's the one you can actually stick with for decades. So what does all of this mean practically? It means that building a financial plan that actually works requires honest assessment of who you are right now, not who you wish you were. It requires building in flexibility and buffer room instead of optimizing every cent. It requires coordinating with the other people in your life instead of treating money as a solo activity. It requires aligning your financial strategy with your identity and values instead of fighting against them. It requires designing for resilience instead of maximum efficiency. It requires focusing on systems and automation instead of relying on willpower and discipline. And most importantly, it requires accepting that the plan will need to change as your life changes, rather than treating it as a sacred document that must be followed no matter what. Financial plans fail quietly because the failures don't look like failures at first. They look like small deviations, minor adjustments, temporary setbacks. But those small cracks compound over time until the entire structure collapses and you left wondering what went wrong. The answer is usually that nothing went wrong with you. What went wrong was the plan itself. It was built on faulty assumptions about human behavior, about how life unfolds, about what's actually sustainable over the long term. When you understand where the real fractures occur, you can build something stronger, something that bends instead of breaks, something that works with reality instead of against it. If this perspective changed how you think about financial planning, hit that like button. Drop a comment with the biggest assumption you made in your own financial strategy that didn't hold up when real life got involved. And subscribe because we're going to keep breaking down the difference between advice that sounds good and strategies that actually work when you need them to.